Aaron, Pete, thank you for joining us.
Thank you for having me.
What a timely moment to have you to talk about sustainability, especially in the vein of labor. We're watching historic strikes take corporate America. You look at what happened at Kaiser just recently, what's happening with the United Auto Workers. When you see what's happening, what does this tell you about the bigger picture on how labor is fitting into the story on sustainability in corporate America?
Well, I think these are all symptoms of a broken social contract between companies and labor, between capital and labor. So whether it's in healthcare or in autos or the writer's strike, we've got issues around wages. I mean, even with all of the increase in wages, net of inflation, are still pretty much flat. So people are still struggling to get by. And the wealth divide is so enormous, and the lack of wealth in the bottom half of the country is such a problem that it amplifies all of the other issues around staffing shortages, people feeling like they're overworked because they're not getting anywhere. And so, employee ownership, which I know we're going to talk about, I'm not saying it's going to magically solve all of our labor issues, but I think it could be a part of fixing this social contract. So workers are going to get a stake in the outcome. They can build real wealth. They're going to have a voice in their workplace. They're going to understand where the business is headed if we do a good job of creating these ownership cultures. And that's what we're trying to do, is make this ownership mindset and sharing ownership a part of this new social contract.
Now let's talk more about ownership works, what you're doing at KKR. The idea here, the private equity pitch, is give employees more ownership of the company, give them equity. How does that start to solve the problem, and what are the limitations of the fix?
And so the problems are, as I mentioned, the lack of wealth among workers, but also low engagement levels. So Gallup, as you probably know, is the 800-pound gorilla in employee engagement surveys. 70% of Americans don't like their job. 15 to 20% of employees at any individual company hate their employer. Gallup describes them as actively disengaged. So they are throwing the proverbial wrenches in the machines, literally trying to hurt the company that they work for. The Treasury Department does a survey every year about financial literacy. 2/3 of Americans are financially illiterate. They can't answer 5 basic personal finance questions. So there's a lot of, the quit rate, so that the percentage of Americans voluntarily walking out the door every year spiked to 40%. So 4 in 10 Americans quitting their job every year, which is bad for people because they're not building skills, they're just bouncing from job to job. It's bad for companies, it's bad for the economy. So those are some of all of our issues. And to your point on how far can we go with ownership and fixing these, it's not going to solve them entirely, but certainly it can help with wealth creation. Certainly it can help with employee engagement and this issue of 70% of Americans not liking their job. If they have information about what is actually going on with the company, how they can contribute, and getting real information. In financial literacy, there's a lot of work being done in the country on financial literacy. We're making no progress. And the reason is, even when a benefit is offered, workers don't engage on the financial literacy training because they have no hope, because they have no assets. Why am I going to go spend time with a coach if I don't own anything? So I think we can get a long way with ownership in this broader sense.
Yeah, let's take public companies just as an example here, because you have auto workers, for example, fighting for more pay. And they look at the CEOs of the company and their pay is just skyrocketing relative to their own. A lot of that is inequity. So when you're talking to employees of a company, how hard is it to get them to want equity rather than cash? Is it a hard sell?
So this is a fundamental, and I'm glad you raised this, a fundamental point, which is equity cannot be a trade for wages. So this is not about having workers risk benefits or wages or other forms of retirement planning to get some stock. That would be bad finance theory, because a big concentrated bet on one stock is not smart. And when it's your employer, you're already levered to your employer's success. And then if the employer has a problem and you lose your job and you lose your retirement, that's a disaster. So the whole idea here is stock for workers is incremental, it's free, they don't buy it. And then you say, well, what's in it for the company? What the company gets is a better culture, is lower quit rates. We have case studies, and none of this happens fast. This takes like a decade sometimes. But we have case studies where the quit rate dropped 90%. So we have a company that over the course of 10 years, at the end of the journey, was hiring 3,000 fewer people every year. and the engagement scores went from the 20th percentile to the 90th. So that's the payback, is you have a more engaged workforce, happier on the job, they want to contribute, they're not walking out the door. That's the payback. It's not a trade for wages.
Now, KKR is already doing this with a lot of companies. More than 60,000 non-management employees have received kind of this benefit, if you will. Let's take a quick look here at a case study that KKR has given us for this program.
Imagine you wake up on a random Wednesday in the middle of your life, and everything that you've ever wanted to do in your life, you can do now. All because you in work and you did things the right way, and someone held up their word to you.
All right, this is a little different than when we normally get together. Anybody want to have an owners meeting?
We do have some news to share, and the news is we found a new owner for the business. So, logical question would be, what does this mean for you financially? Because you're all owners in this business. You guys ready to get into it? Even our newest colleagues are going to get a meaningful payout of $20,000. Well, if you think that was good, hold on to your hats. If you joined last year, the payout is $40,000. So for this cohort, the payout is 1.5 times annual pay. So the average payout is $70,000 for this group. And that was a very abbreviated version of this was a much longer presentation. That was just in one of the manufacturing plants. If you follow through to the end of that, you know, we had truck drivers make almost $1 million. I mean, this was not a token amount of ownership. And the company did amazingly well. I mean, for those who are financially inclined, the EBITDA margins, the measure of profitability in this business, went from 20%, which would have already been top quartile for a manufacturer, to almost 40%, which is like a software company. And it was all driven by, over many years, these little productivity initiatives that the entirety of the workforce pulled together to make happen. So it was, you know, it's one of these things where, yes, it's a great story for workers, but, you know, our investors made 10 times their money on a garage door company, which people would have said it's not possible. How could you possibly have that kind of an outcome? And it's because of what the entirety of the workforce came together and was able to drive.
It's funny, you saw people cheering when they said they had a new owner. Usually private equity is scary to people when they come in and buy a company. How is this kind of changing the image of private equity, especially now that KKR is not the only one doing this? You have signed up many of your rivals to start doing this as well.
Yes, and this is not about trying to burnish the image of private equity. This employee ownership effort, it is broad. You know, Ownership Works, which is a nonprofit foundation that my wife and I started to try and make this a more common effort and to help CEOs roll this model out, because it's difficult. It sounds so easy. We could talk about that. This is very hard to do. And we do have almost 100 organizations that are a part of this now. We've got, we think, a path to creating $20 billion of wealth across all of our partners for workers over the next 10 years, which in the context of the total lack of wealth in the bottom half of the country is a very big deal. But we are working with public companies. We worked with Harley-Davidson, was a story that Bloomberg covered. We have no financial interest in Harley. The CEO just called out of the blue and said, I got brought in to turn this company around. I'm inheriting a not great relationship with the workforce and with the union. We need to really turn a new page here. And the totality of this model intrigues me, not just ownership, but worker voice and communications and financial literacy. Could you work with us to help roll this out? So it's public companies, it's family-owned businesses, it's small business. There's a lot here that we could tackle. One last thing, the power of private equity in this context is it's such an effective governance model. So take that Harley-Davidson example. I spent many, many months with the CEO and the board rolling this out, getting people comfortable, and it impacted 4,000 workers, all union, by the way. There's a big misconception that unions don't want ownership. That is not true. But if I spent that same amount of time convincing the CEO of a private equity firm to do this, you could have 500,000 workers, because there's so many companies that roll up to a very consolidated set of decision makers.
And I should say, if you have questions for Pete, please do submit them. We may have some time to take a few questions. You mentioned unions. We started in that space, in this idea that there has been a huge tension between unions and employers. What are your conversations looking like, and how does this really play a role in the story?
So we spend a fair bit of time. Here's what I would say the mindset of a union leader is: there's a lot of unfairness in the economy. We need to get a better place in wages, staffing levels, worker voice, but also we need to help, as we all know, defined benefit pension plans are gone. 401ks are great if you can afford to contribute. How can workers get anywhere? And union leaders are saying this may help. You know, it's not the solution, but what's wrong with getting more alignment between workers and a company? Sorry.
Well, one thing you and I have talked about before is this idea that if you're building wealth in America these days, a traditional way you used to do it was to buy a house and watch that equity grow. It's very difficult to buy a house for many Americans today. How does having equity in a company start to change some of that story?
Yeah. If working folks don't have savings, they can't put a down payment on a home, and they can't invest in stocks, obviously. So this can start to change the story because it's not an investment. It's a free benefit that can compound at high rates of return. I mean, the problem, if you look at Federal Reserve data on household wealth, there's a lot of talk about housing. The only thing that matters is stock ownership. If you look at the numbers, it is by far the biggest problem we have in wealth inequality. So the first year the Fed gives data is, I believe, 1989. And at that point in time, the top 10% of Americans had $1.7 trillion of wealth, and the bottom half of the country had, I think, 50 billion. Now we go 33 years later, where are we? That $1.7 trillion gap is now $30 trillion. So the top 10%, which had $1.7 trillion, have 30 trillion. And the bottom half have gone nowhere. They've went from 50 billion to 200 billion. So how did that happen? As we know, stocks compound at high rates over long periods of time. Yes, there's volatility, but over long periods of time, stocks do well, better than housing. And we're going to have to get appreciating assets in the hands of the bottom half of the country, or that 30 trillion is going to be 300 trillion, that gap. And it'll blow the whole system up. So we've got to find a way to, appreciating assets have got to be spread more broadly.
Now, we've been talking a lot about what this means for the employee, but what about the investor? I recall a conversation I had about a couple of years ago with the CEO of CalPERS. We were talking about ESG data and the importance of monitoring that data over time. And to her, we were talking about Scope 1, Scope 2 emissions, but importantly, we were also talking about employee turnover, employees being able to be engaged in their companies. What is the data that you have? What is the evidence that you have that more engaged employees that have a stake in the game, kind of like a money manager would, how does that lead to better outcomes?
So the gold standard metrics, and CalPERS is one of our core partners in all of this, are the gold standard metrics around how employees are feeling and what they're contributing to a company are the quit rate and employee engagement. A survey issued by someone like a Gallup. Those are the gold standard metrics. So we've got a lot of data that when this is done well, and as I mentioned earlier, this is hard. It's not like you hand out some stock and people stop quitting and engagement scores go up. This is a multi-year effort with tons of communication, education, training, information sharing, soliciting people's input, giving them more control over the work. This is very hard. But when it's done well, what you see is quit rates go down and engagement scores go up. Now, the point of your question is, okay, great, then what? And what we've seen, and we've spent so much time with economists at Harvard and Stanford and MIT, and it's very difficult to then say, and productivity gains were driven this much because you had more engaged employees who were less likely to quit. That's really hard. So what you'd have to do is basically have perfect control sample to compare to a group of companies that you are rolling this model out with, and then a bunch that you don't, and they have to be identical, and it's not possible. So where we stop is we're going to prove employees will become less likely to quit, more engaged on the job, and in aggregate, we're going to have better, the end results are going to be better, which is what we've seen. I mean, the 10 or so companies we've exited have been among the best deals we've done in the last decade where we've had this model. So we're convinced this leads to superior results for everybody, workers and investors alike, and that's what our investors believe as well.
This seems like it's not that hard of a fix on the face of it, in the sense that how hard is it to say, okay, you know, yes, you still would have to increase wages and do X, Y, and Z to make your workforce more engaged, but also if you do this thing where you give employees a stake in the game, things can be better. Why is it so hard then for this to take off? What resistance do you get from other private equity firms, owners, and CEOs?
Okay, so if we start with CEOs and we talk about this program, a CEO will say, okay, Pete, so just so I understand what you're asking me to do in the next 5, 6, 7 years is you want me to double earnings, you want me to decarbonize, you want me to diversify the board, the C-suite, and change the way we recruit to add diversity throughout the entirety of the company. You want the financials by the 12th of the month. You want, and there's such a long list around water, waste, energy. And then, if I understand you right, now you want me to figure out how to turn like 17,000 people in 80 countries, owners in the business, teach them about the company, drive employee engagement, teach them financial literacy, lower the quit rate. What do you want me to do? Because I can't do all of that. And the magic is if we can get that CEO to understand if he or she does those last things well, all the other priorities are going to be so much easier to tackle. But there's a huge initial pushback of like, oh my goodness, how am I going to do this? And that's also what part of what Ownership Works is there to do, is to help people who really want to go on this journey do it. I would say, honestly, that's the biggest obstacle, is CEOs are drowning in priorities.
So there's another element of this. You made this amazing anecdote a little earlier about a truck driver you had been working with that ended up with $1 million at the end through the equity he was able to amass through his time working. How often does a story like that happen?
So that was an unusual case. We don't often have blue-collar folks make $1 million. But I think what we also try to clearly communicate is it does not have to be a 10x, like, unbelievable transaction for people to do well. So we exited, just in recent months, Minnesota Rubber and Plastics, which was a good deal for us. It wasn't, a blowout. It was good, and workers made 100% of their income as an incremental free benefit in stock. We exited RB Media, an audiobooks business. Same thing. People who had at least been there a couple years earned 100% of their income in stock. And these are deals we will do over and over and over again. These are not 10x deals. So sometimes the headlines drift towards the amazing outcomes, which we also like to talk about. Where we do want to be clear, this doesn't need to be magic. I mean, this can work where you grind out solid transactions and people participate and it's meaningful. And by the way, I want to reiterate, it's not just about the stock and the money. This is about how they feel. Do they feel trusted? Do they feel respected? And ownership, in some regards, is the ultimate form of trust and respect. I respect you enough to make you an owner. I trust you enough to be sharing our profit margins. I mean, that's a big shift.
So this is something that you've done as the global co-head of private equity at KKR. It's also something you've done in your personal life through your nonprofit. What is the next phase of this for you?
That's a great question. Not ready to talk too much about it at the moment, but there's a policy effort that's coming. We need help from the government to really scale this. So hopefully we will be ready to launch that before too long. I've been working with a major university to establish an employee ownership center. We need more research into this. And we need to take a shot at massively scaling this. We've had some good case studies. I'm very proud that we've got over 100,000 workers across at Ownership Works in these programs. Even if they make $50,000, that's $5 billion of wealth. I mean, the numbers are so big. And I think we'll get to 20 billion, as I said, in the next 10 years. But we need to try this. What we're doing now isn't working. I think this could be part of a different kind of approach.
Pete, we thank you so much for your time. What a way to kick off the sessions. Thank you so much.